Welcome back. So, we've talked about the basics of commercial real estate debt before, but today we're going to go a level deeper. We're looking at how the really sophisticated firms don't just take on debt, they use it as a powerful strategic tool to absolutely crush their long-term goals. For most people, that's what it is, right? It's a loan. It's just a number on a balance sheet, a cost you have to deal with every month. But what if that's only looking at half of the picture? Because that's exactly how the best in the business see it. They don't just get debt, they meticulously design it. They build a financial structure that isn't just about funding one deal, it's about setting that deal up for massive success from the very beginning. So how do they do it? Well, it breaks down into three main pillars. Okay, let's get into our first pillar, understanding the capital stack. I want you to think of this as the financial blueprint, the DNA of any single real estate deal. Think of it like you're building a pyramid to finance, let's say, a $100 million property. Every single layer of that pyramid plays a different part, comes with a different price tag, and carries a different level of risk. And trust me, getting those layers just right is everything. So at the very bottom, the huge, stable foundation of our pyramid, that's your senior debt. This is usually the cheapest money you can get, typically from a big bank. So for our $100 million deal, the bank might give you $60 million. But, and there's always a but, they have very strict rules, and they'll only fund up to a certain point. So what about the other $40 million you still need? Well, that's where the next layer comes in, something called mezzanine debt. It literally sits on top of the senior debt, bridging that gap. A mezz lender might kick in another $20 million. It's way more flexible than the bank, but it's also way more expensive. And right at the tippy top of our pyramid, the final piece of the puzzle is the equity. This is the firm's own cash or money from their investors that fills that very last gap. In our example, the final $20 million to make the deal happen. And this slide right here, it lays out the fundamental trade-off perfectly. You've got your senior debt, low cost, low risk, but it only gets you so far. Then you have mezzanine debt, which gives you that extra horsepower to get across the finish line, but you are definitely going to pay a premium for it. So here's the real art in all of this. The goal is to blend these different layers together perfectly. You want to structure that entire stack to get the lowest possible blended cost of capital for that $100 million, all while making sure the risk level is something the firm can comfortably live with. All right, let's move on to pillar number 2, because this is where it gets really interesting. See, it's not enough to just build a clever capital stack. You have to make sure your debt actually makes sense for the property's specific income profile. You have to remember that every property has its own personality. You've got your stabilized asset, think of a fully leased office building with top-tier tenants locked into long-term contracts. The cash flow from that is as predictable as the sunrise. And then you have your transitional asset, maybe an old warehouse that's being turned into trendy apartments. Its income starts at zero and then hopefully grows over time as you lease it up. And this is where the strategy really shines. It's about perfect matchmaking. For that super steady, stabilized asset, a predictable fixed-rate loan is a perfect fit. But for that transitional warehouse with its up and down income, you need flexible financing that can roll with the punches. Getting this wrong is, well, it's like putting diesel in a gasoline engine. You could have a fantastic asset on your hands and be forced to sell it at a terrible price just because you can't make a loan payment. And now for our third and final pillar. We're going to zoom out now, from looking at just one building to looking at the entire collection of properties, the whole portfolio. This is the million-dollar question, or maybe the billion-dollar question, that every portfolio manager has to wrestle with. It's about managing your debt strategy not for one deal, but for dozens or even hundreds, all at the same time. This table really shows you the core dilemma. On one hand, you've got fixed-rate debt. It gives you incredible predictability. You know exactly what your payments are going to be, and you can sleep at night, protected from interest rate hikes. But it can lock you in. On the other hand, floating rate debt gives you amazing flexibility to sell or refinance without massive penalties, but it straps you into the market roller coaster. Just imagine your portfolio is 80% floating rate debt, and the Fed suddenly jacks up interest rates. Your costs could explode overnight and just crush your cash flow. You see, too much of either one is a huge risk. And that's the key here. There is no magic formula, no one-size-fits-all answer. The perfect balance between fixed and floating rates, or between short-term and long-term loans, is a dynamic strategy. It's a constant chess match that shifts based on the firm's goals and what's happening in the wider economy. So, after diving into the capital stack, aligning cash flow, and balancing the portfolio, let's just tie it all together. Why does going to all this trouble actually matter so much? Because when you get it right, a smart debt strategy does three incredibly important things. First, it enables growth, letting you go after more and better opportunities. Second, it manages your risk, creating a portfolio that's resilient enough to handle market shocks. And finally, it preserves and enhances the long-term value of your assets. It's literally the engine that drives sustainable success. And that quote really says it all. In the world we live in today, thinking this strategically about your debt, it isn't just a way to get an edge. It's what's absolutely required just to stay in the game and thrive, no matter what the market throws at you.